Today we're looking at something that almost nobody in mainstream financial media is talking about. While silver futures briefly dropped to 72 or 62 during thin holiday liquidity, one of the largest precious metal streaming companies in the world committed $4.3 billion in a long-term agreement with BHP. That capital wasn't theoretical, it wasn't a tweet, it wasn't a prediction, it was wired money. And before we go any further, let me say this clearly. If you want consistent updates that cut through paper price noise and focus on what institutional capital is actually doing, make sure you subscribe to the channel right now. If this kind of deep, research-driven breakdown helps you think more clearly about markets, hit that subscribe button and stay connected. We track real money flows here, not just headlines. Now, here's what happened. On February 17, 2026, the exact same day silver futures printed an intraday low of 72.62. Wheaton Precious Metals finalized a $4.3 billion streaming agreement with BHP. Under the agreement, Wheaton secures BHP's 33.75% share of silver production from the Antamina mine in Peru. That equates to an expected average of roughly 6 million ounces per year for the first 5 years, with up to 100 million ounces delivered before the stream structure adjusts. So on one side of the market, you had futures traders reacting to thin liquidity, holiday conditions, and macro headlines. On the other side, you had a major institutional player committing billions to lock in long-term silver supply. And if you're finding value in this type of detailed, institutional-level analysis, again, make sure you're subscribed. Around 70–75% of viewers typically aren't. If you want to stay ahead of major capital moves like this, join the community. Now let's continue. Let's break down the numbers in context. COMEX registered silver inventories currently sit around 102 million ounces. This single streaming agreement represents a claim on up to 100 million ounces before reduction, nearly equivalent to the entire registered inventory currently available for delivery. Globally, annual silver mine production runs roughly 800 to 850 million ounces. By securing BHP's 33.75% share from one of the world's most important polymetallic mines, Wheaton meaningfully increases its long-term exposure to physical silver output. And this isn't a speculative junior miner. The Antamina mine in Peru is one of the largest and most established polymetallic operations in the world, producing copper, zinc, lead, molybdenum, and silver. This is an operating asset with a production history, not a concept. Now let's talk about who Wheaton Precious Metals is and why that matters. Wheaton is not a retail trader chasing momentum. It's one of the world's largest precious metal streaming companies. The streaming model works like this. They provide upfront capital to mining companies. In exchange, they receive the right to purchase a portion of future production at a fixed or discounted rate. Their profitability depends on accurately modeling long-term metal prices, supply trends, and global demand over decades, not days. When a company structured around 20 to 30-year projections commits $4.3 billion, it does so after running extensive economic modeling. They analyze industrial demand growth, energy transition trends, supply deficits, geopolitical risk, currency cycles, and inventory dynamics. And right now, several structural factors are in play. The Silver Institute has projected another annual supply deficit, marking multiple consecutive years of shortfall. Industrial demand remains elevated, driven by solar, EV infrastructure, electronics, AI data centers, and defense applications. Physical investment demand is forecast to increase significantly. COMEX inventories have declined meaningfully in recent months. China has implemented export controls affecting refined silver supply chains. These are long-duration variables, not intraday trading catalysts. Now contrast that with what caused the 72.62 print. The drop occurred during extremely thin liquidity. Asian markets were closed for Lunar New Year. The U.S. had just returned from a holiday. Geopolitical developments temporarily reduced safe haven demand. The dollar ticked higher. In thin markets, relatively small flows can exaggerate price movement. That doesn't mean the price move was fake. It means it occurred in a low liquidity environment where futures can disconnect from underlying long-term fundamentals. Here's the key distinction. Futures markets reflect short-term positioning and liquidity conditions. Streaming agreements reflect multi-decade supply expectations. Wheaton did not wait for a breakout confirmation. They did not wait for silver to trade at $80 or $90. They locked in supply at today's valuation framework during a moment of price weakness. That timing is worth noting. Now let's look at COMEX dynamics. Registered inventory stands near 102 million ounces. Open interest in upcoming contracts represents multiples of that amount in notional exposure. First notice day for the March contract approaches quickly. While most futures contracts are cash settled or rolled, the paper-to-physical leverage ratio remains structurally high. This deal does not add silver to COMEX warehouses. It secures future production into a streaming arrangement. In other words, long-term supply is being contractually allocated. At the same time, industrial demand remains historically strong. Silver is not just a monetary metal. It's an industrial input critical to energy transition technologies. Solar panel manufacturing alone consumes substantial annual supply, and that trajectory continues upward. Add to that the refining dynamic. China controls a dominant share of global silver refining capacity. Recent export restrictions limiting shipments to refiners above certain capacity thresholds introduce additional supply chain complexity. In that context, securing production from a Peruvian mine under a long-term agreement becomes strategically more valuable. Wheaton effectively purchased exposure to non-Chinese, Western-aligned silver supply in a tightening geopolitical environment. Let's talk about valuation logic. Streaming companies typically purchase metal at a fixed percentage of spot. Their upfront payment is calculated using discounted cash flow models based on long-term price assumptions. For $4.3 billion to make economic sense, Wheaton's internal price deck must assume silver prices meaningfully supportive over the coming decades. That does not guarantee price increases next week or next month. It does indicate confidence in structural value over long-time horizons. Now, none of this eliminates risk. Silver is volatile. It can move sharply in both directions. If macro conditions shift, if global growth slows, if delivery pressures ease, prices could retrace further in the short term. Futures markets respond quickly to changing sentiment. But institutional capital is positioning for decades, not days. That's the divergence. Retail participants often react to price. Institutions allocate based on modeled scarcity, structural demand, and long-term supply agreements. On February 17, 2026, two things happened simultaneously. The futures market printed 72.62s. A major streaming company committed $4.3 billion. Both events are real. Both reflect different time horizons. 25 years from now, nobody will remember the thin liquidity conditions of a holiday-distorted session. What will matter is whether silver averaged significantly above today's price over the life of that agreement. Wheaton is betting that long-term fundamentals justify locking in supply now. That doesn't mean blind optimism is warranted. It means disciplined analysis is required. If you're following this market, don't focus only on hourly candles. Watch inventory trends, watch industrial fabrication data, watch refining policy changes, watch how major capital allocators position during weakness, and most importantly, think independently. Do your own research. Evaluate risks, understand volatility. Never invest based solely on commentary, including mine. But when billions of dollars move in one direction, while sentiment moves the other, it deserves attention. The paper market reacts. Institutional capital positions. The only question is which signal carries more weight over time. If you found this breakdown useful, stay connected. We'll continue tracking the intersection between futures pricing, physical supply, and institutional capital flows. Invest with logic, stay informed, and always use your own judgment.